This is CRE Deep Dive, hosted by Dennis Bamford. We go behind the scenes of high-level commercial real estate, breaking down deal structures and advanced capital strategies, including self-directed IRAs that move investors from Wall Street into real assets, real deals, real execution, real control over your wealth. Let's get into it.
Directed IRA, Lindsay Mersino. I'm sorry, could you?
Yes, it's Lindsay Mersino.
Mersino. I practiced that and still didn't get it right. Today, she's going to be giving us a breakdown on using the IRA LLCs and how we use them in real estate. Some of the things she's going to be covering is tax benefits, how depreciation is affected when it's in a IRA, prohibited transactions, and UBTI and UDFI, and how this is triggered.
Absolutely. We're so excited to jump in, and thank you for having me back. I know that we recorded more of a one-on-one kind of basics already, and so we're excited to dive into some of the deeper concepts like you mentioned.
Yeah, awesome. Yeah, no, that it was a great conversation, and we could have kept going.
Oh, yes.
It was my longest podcast, and I was like, and there was not even, so it was like, definitely want to get back together. So let's start out with the tax benefits of.
Yeah. So what's funny is people, when they set up an LLC, whether it's an IRA LLC or just a normal LLC, they often think that setting up an LLC gives you tax benefits right away. But it doesn't always do that, especially when it's a single member LLC. It's really just a pass-through entity to that one sole person that is behind the LLC. So it doesn't necessarily help when it comes to taxes. But when you're looking at whether to utilize an IRA LLC or not, it really comes down to three major factors. The first factor is privacy. When you're investing with your IRA is listed as the buyer or purchaser or lender, subscriber, etc. Some people prefer to not have it be known that they're using their IRA. So if you have an IRA LLC, all of the investing is done through the LLC's name. So we could set something up like Dennis LLC, and they would have no idea that you're using your Roth IRA dollars, because the lender or the buyer or the purchaser would read Dennis LLC as opposed to Directed Trust Company for the benefit of Dennis's Roth IRA. So that can be really beneficial. It gives you some privacy. The second thing that it does is it allows you to move a lot more quickly. When you have an IRA, you have to have a trust company or bank servicing that retirement account. They have to be the ones that are the trustee controlling that account. So as with all large companies, take a little time to review and process requests, especially in the private investment world. It's not like you're just clicking a button to buy publicly traded stock. You have to submit documentation that has to be read by a human. So when it comes to moving investments and making investments for our clients, if you don't have the IRA LLC, we still move real quickly. We process everything in less than 3 days, normally 2, but less than 3 days is our marker. That's our service level agreement that we abide by. But if you have an IRA LLC, you are the uncompensated manager of that LLC. You can send out a wire in 10 seconds. You can sign documents in 1 minute. You can go to lunch and write checks and sign agreements with people right away. So if you want to move really quickly, or if you're going to like a real estate auction or a tax lien auction, the IRA LLC can be really beneficial because you've got that checkbook in your hand and you have the control over making those decisions a lot more quickly than we would in 3 days or less. You can do it again in 3 minutes or less. So the number one is privacy. Number two is expediency when it comes to the transaction and your needs. And then the third reason that people like it is that it also saves them long term on transaction costs with their trust company if they're a really active investor. So if you're doing more than 2 or 3 investments per year, a lot of people would like to do the IRA LLC so that they can just be more in control. But if you use the IRA LLC, then you'll avoid our measly $35 fee. So it's still not much if we're processing your requests for you without the IRA LLC. But if you have the IRA LLC, you'll save on the $35 transaction costs each time with us. So those are the 3 main reasons why people would use it. So it's not necessarily going to be hitting on the tax benefits immediately, but as far as tax benefits go, it's going to keep you a lot more organized because you're keeping it under that separate entity versus everything just being under your name or your IRA.
But with all that comes the great responsibility of making sure you're not breaking any of these laws, right?
Absolutely. And that's a really great point, Dennis. It's funny because a lot of people will look at that as a pro, right? They're like, yeah, I want to be the one responsible for looking at everything. I want to be the one responsible for making sure nothing bad happens. They like that. But then some people look at that as a con. They don't want to be part of all of it.
Right.
So if you
Yeah.
don't want to be in it really with your self-directed account and you're looking for something more passive, the IRA LLC might not be the best option for you. But if you're
Yeah.
doing real estate investments and fix and flips on a regular basis, you're doing 1 or 2 properties or 3 properties a year, the IRA LLC starts to look really appealing.
Yeah. Yeah. Okay. Like you were saying, for those active strategies, like, the fix and flips and wholesaling, how long, like holding these properties, is there some kind of timeline for the short-term gain? And what would be an issue there?
Yeah. So specifically when it comes to fix and flips within a retirement account, the IRS looks at your retirement account as something that's passively earning money for your future. It's not necessarily supposed to be this active investment that you're in the weeds on and spending 10 hours a day on, per se. So, with a fix and flip, as you can imagine, it's hard for that to look passive if you're doing 4, 5, 10, 20 of them per year. The IRS starts to look at that as, oh, this is a normal active business. It's no longer just a passive real estate investment in your retirement account. So with that said, when you look online, you'll find a lot of different answers about what is the guideline for how many fix and flips you should do per year, or how long should you hold it in order to avoid any issues. And what it comes down to is, again, whether it's active or passive, and that can be hard to prove whether it is or not in some instances. So the rule of thumb, the area that you can absolutely stay safe in, is 2 to 3 fix and flips per year. We don't care if it's held for 60 days, 90 days, 12 months. That's not necessarily a factor. It just comes down to how many and the quantity that you're doing per year. So if you're staying around 2 or 3 per year, you're in the safe zone. You may see some articles online that say 4 or 5 is a safe zone. Consult with your attorney, make sure you're always staying in that safe zone for sure, but 2 or 3 is what we will tell people very comfortably.
How is the state level income and transfer taxes if you're investing out of state from
Yeah.
where you're domiciled?
Oh, that's a great question. I'm not actually sure if there is anything that gets triggered or not because typically with the IRA LLC, people are going to establish the LLC in the state in which their property is if they're doing real estate. So I'm not familiar with any of the taxation that would occur due to mismatching of states, but that would definitely be something to discuss with your attorney and see if it's a concern, but
Yeah.
I haven't heard of that before.
Okay. How about the depreciation? I think that's
Yeah.
probably misunderstood. And so could you give us a little bit of the rundown on the how depreciation is handled? Is it handled differently from a self-directed IRA versus an IRA LLC?
So, when it comes to an IRA versus an IRA LLC, the depreciation is not impacted any differently at all, whether it's in an IRA directly or the IRA LLC. The area that you'll want to be aware of is when it comes to depreciation, the whole point of depreciating assets is to save you on taxes. Well, within the IRA's investments, there's no taxes to depreciate typically. The only time that depreciation is ever going to even be considered or play a part in the IRA or IRA LLC investments is if you have some sort of taxation that you have to counter. In an IRA investment, that's going to only be UDFI or UBIT tax that could arise. So if you're engaging in a deal where UBIT or UDFI is going to be triggered, then yes, you can depreciate using the depreciation related to the real estate. You can use that in order to counter those taxes. But if you're engaging in an investment where there's no debt involved, which would trigger the UBIT or UDFI, there's nothing to depreciate, so you don't use the depreciation.
Yeah, you pretty much, I think my next question's already been answered. So
Perfect.
let's go on to some of these prohibited transactions. What is a prohibited transaction?
Oh, that's a good one. So, a prohibited transaction, also affectionately known as a PT in this industry, a prohibited transaction is when you engage in something with your IRA that is prohibited. And I will elaborate. There's a few different kinds. But for example, you are not permitted to extend your credit to your IRA. So, what that means is you cannot go out and get a traditional mortgage related to the investments within your IRA. That would cause you to extend your credit history to your IRA. So, you can't do that. If you did something like that, would be considered a prohibited transaction. Another type of prohibited transaction would relate to the asset classes that you're choosing to invest in. So, the IRS says no life insurance and no collectibles. Lastly, no S Corp shares either. So those are the three investments that your IRA cannot make under any circumstances. If it were to make an investment in any of those areas, it would be a prohibited transaction. The last one would be if you engage in a transaction that involves a disqualified party is anyone of lineal ascent or descent to you, plus yourself and your spouse. A disqualified party, which again, myself, my spouse, anyone of lineal ascent or descent to me, those individuals cannot interact or transact with my IRA's investments. So in other words, if I have an IRA that owns a property, I cannot rent that property out to my child. So my son or daughter would not be permitted to rent the property from my IRA. I also cannot hire, my mother's construction company to come work on the property. That would be a prohibited transaction caused by a disqualified party transaction. So that's just a few examples of different things that would qualify as a prohibited transaction. This type of thing doesn't really come up in the traditional investing world because you're buying publicly traded assets. So you don't really have to worry about your parent owning Google, probably, if you want to buy Google stock shares or something like that. But when it comes to the private investment world, just be aware of those particular parties and those types of transactions that are prohibited. The good news is that there's still billions of people out there that are not disqualified parties. So don't let that be your pause for making an investment through your self-directed IRA.
Okay. So my next question is, if an investor wants to partner their personal funds with their IRA LLC funds to buy a larger multifamily asset, what are the guardrails that we must have in place day one to ensure that we don't violate some kind of IRS rules?
Totally. So before I answer this, I will always tell everybody to absolutely meet with their legal advisors or their attorneys. What I'll explain to you is a way to absolutely 100% do this. It is perfectly legal. It's been proven in court. It's definitely acceptable. But when it comes down to your particular deal, there may be one small factor I'm not aware of that could completely remove this as an option for you. So always work with your legal professionals on ensuring that you're structuring the deal properly. But one of the ways that we see people do this is they just simply set up a multi-member IRA LLC. So
Mhm.
what they would do is they would have an IRA LLC established, but on day one, there's two members listed on the operating agreement. The first member is going to be your IRA. So just like an IRA LLC, your IRA is going to be listed as a member. The second member is going to be listed as you as an individual. Now, where it gets a little bit tricky is choosing the percentages and determining the share percentages between those two parties and those two members of that IRA LLC. In other words, if my IRA has $100,000 in it And I also have $100,000 personally that I want to invest in this opportunity as well. What would have to take place is I would reach out to a firm that is familiar with IRA LLCs. We work with KKOS lawyers personally, but you would reach out to a firm that knows how to set these up. And what I would do with that example is I would have KKOS set up an LLC that has two members split evenly at 50% each. What that does is it allows us to have the funds go into the IRA LLC on the same day at the same time. That's what's referred to in the legal world as ab initio. When you establish the LLC and ab initio, meaning from inception, when it's from inception set up like that, and the day one of the LLC lists 50-50 for you and your IRA, and then money hits that account from your IRA and from you personally also on the same day, you're creating this investment from inception. So you're not transacting with your IRA by doing so. So now you have an IRA LLC that has $200,000 in it, and 50% is owned by the IRA and 50% is owned by me. Now that could look like a prohibited transaction, but again, ab initio, from inception, we did not transact with each other. We put money in and committed to this at the same time, so we weren't transacting with each other. So now we've got that 50-50 split. Any of the income earned by that LLC, 50-50, 50% is owed to me, 50% is owed to my IRA. We can leave it in that bank account for the LLC. You don't have to split it and take it out, but for the future, 50% of the income is the IRA's and 50% of the income is mine personally. Same thing with expenses. 50% is owed by my IRA, 50% is owed by me personally. Now, it's all coming and going in and out of the LLC as one transaction. It's not, hey, here's $500 for you and $500 for the IRA. It's just coming back to the LLC and we split it accordingly. Now, the catch is what I'm about to tell you now, Dennis, and that is specifically that 50% share that I talked about earlier. That is locked in from day one. You cannot change it. So in other words, if I have an extra $10,000 I want to throw in personally, I cannot do that unless my IRA also puts $10,000 in as well. So this could cause an issue for people down the road, because if you have to put more money in, but your IRA can't put more money in, what do? So that's just one option, but you got to be extra cautious. You got to be aware of that future split if you were in a pickle where you had to inject more capital into this particular LLC. So those are just some watch outs to be aware of, but it's absolutely possible. We also see people do it with 2 single member LLCs as well. The cost is a little higher, but it keeps it nice and clean. 100% goes to the IRA, 100% goes to you. But most people do that multi-member LLC.
Okay. All right. Yeah. Wow. It was good. Yeah.
That was a fire hose of information, Dennis. I'm so sorry. That was a lot.
Yeah, I was going to say we could probably unpack that little blurb right there for about an hour. So anyway, so let's move on to the UBTI or UDFI and how these are triggered. Could you explain the unrelated business tax income and the unrelated debt finance income?
Yes, absolutely. So UBTI is specifically to ensure, again, that the investments in your IRA or retirement accounts are actually passive. So you could potentially trigger the UBTI tax when you have a normal business that's occurring within your IRA. So for example, my IRA could go out and buy a gas station. That's totally permissible. Kind of crazy, right? To own a gas station with your IRA, but again, it's permissible. So the reason why UBTI would come into play on that is a gas station, that's a normal business. Even though you're not the one working at the business, because you're not allowed to if your IRA owns, it's still considered an active business. Now, it's not very fair for your active business to not be charged tax while the gas station down the street is charged tax. So in order to level the playing field, you would incur something called UBIT there. That's the UBTI tax that could come into play. So that's UBIT. UDFI is something I would think that is a little bit more common in the IRA world, and that's going to be triggered when you utilize any sort of debt related to the investment that you're making. And you want to think about it like this. If I go out and I buy a property with my IRA, but 50% of it was financed with a non-recourse loan or a private lender, well, 50% of the income is not IRA income, right? It's still going back into my IRA, but I am going to owe taxes on that, which can be depreciated, as we mentioned before. But with the UDFI tax, that again will come into play if there's some sort of debt or leverage being used, because at the end of the day, your IRA's income is passive and any non-IRA income could be charged a tax. The UDFI tax is also based on the trust tax brackets. So you could be looking at anywhere from, I think, 10% all the way up to 37% tax that could be charged for this. I always encourage people to look at the deals that they want to do with their IRA. I want them to look at it if they were to do it in the IRA, potentially triggering UBIT and what that cost would be, and then run a calculation of what it would look like if you invested outside of an IRA. I'll tell you this right now, Dennis, anytime we do a side-by-side comparison, the UDFI almost always is less than the amount of tax you would pay if you did it outside of the IRA anyways. So just as an example there.
Yeah. No, that's a good point, because, it's like, oh, I thought this was, my tax exempt, IRA and all this. And it's like, look, and that's like the depreciation also. We'll lump both of those together is, like, I want my depreciation. People get stuck on, I'm not being able to use that benefit. And it's like, hold on, you're getting other benefits that are going, what I mean? So let's not get, you can't have it all.
They often get frustrated because they're like, I want to use the depreciation. I'm like, to depreciate what? There's nothing to depreciate, which is
right. Okay, Lindsay, I appreciate it. It was another great. You took up my last two questions. You already answered them. You're super good.
Oh, thank you so much for having me again, Dennis. It was fun to dive into these more advanced topics related to self-directed IRAs.
Yeah, we'll get together and come up with something else for next time, if that's
Great.
okay with you.
Of course, please. Happy to be on it at any time with you, Dennis. We appreciate you.
Thank you so much, and I hope you have a great day.
Thanks. You too, Dennis. See you later.
Thank you.
You've been listening to CRE Deep Dive with Dennis Bamford. If this episode gave you value, share it with someone who's ready to move beyond traditional investing and into real assets. And if you're an investor, operator, or custodian actively working with self-directed IRAs in commercial real estate and have real experience to share, you can apply to be featured on the show using the links below. We'll see you in the next episode.